Hello everyone, I'm so happy to see you in our Trading Academy again. Today's lesson is about Fibonacci. So let's start. Fibonacci, or his real name, was Leonardo Fibonacci. He was an Italian mathematician, famous by discovering the Fibonacci sequence. The sequence looks like this. Every number in the sequence is simply the sum of the two previous numbers. So 1 plus 1 equals 2, 1 plus 2 equals 3, 2 plus 3 equals 5, and so on. The sequence can then be broken down into ratios, which some believe provide clues to us where a given financial market will move to. The sequence itself is not that important. It's the ratio of these numbers that matters. If you measure the ratio of any number to the succeeding higher number, you will get 0.618. If you measure the ratio between any second number, you will get the ratio 0.382. The Fibonacci sequence is significant because of the so-called golden ratio of 1.618, or its inverse 0.618. In the Fibonacci sequence, any given number is approximately 1.618 times the preceding number, ignoring the first few numbers. Each number is also 0.618 of the number to the right of it, again ignoring the first few numbers in the sequence. The golden ratio is found in nature, where it describes everything from the number of veins in a leaf to the magnetic resonance of spins in cobalt niobate crystals. So why am I telling all this? As you may have guessed, the same ratio is believed to work in the Forex market. Traders use the Fibonacci ratios to find the potential reversal points in the market, as the price tends to find support and resistance at these levels. The 5 key Fibonacci ratios are 23.6, 38.2, 50, 61.8, and 100%. So Fibonacci numbers don't have any specific formula. Rather, it's a sequence where the numbers tend to have certain relationships with each other. So how to calculate Fibonacci retracement levels? The Fibonacci number sequence can be used in different ways to get Fibonacci retracement levels or Fibonacci extension levels. So here's how to find them. Fibonacci retracements require two price points to be chosen on the chart, usually a swing low and a swing high. Once those 2 points are chosen, the Fibonacci numbers, or lines, are drawn as percentages of that move. So if a price rises, for example, from $15 to $20, then the 23.6% level is $18.82, or it's calculated from $20, you extract $5, which is the difference between $15 and $20, and multiply it by 0.236, which equals 18.82. The 50% level is 17.50, or 15 minus $5 multiplied by 0.5, which is equal to 17.50. So basically, Fibonacci extension levels are also derived from the number sequence. As the sequence gets going, you need to divide one number by the prior number to get a ratio of 1.618. Divide a number by 2 places to the left, and the ratio will be 2.618. If you divide a number by 3 to the left, then the ratio will be 4.236. Fibonacci extension requires 3 price points on the chart: the start of a move, the end of a move, and then a point somewhere in between, which is equal to a pullback. If the price rises, for example, from $30 to $40, and these two price levels are points 1 and points 2, then the 61.8% will be $16.18. It is calculated when you multiply $10 difference between $30 and $40, and then you multiply it with 1.618, so this will be above the price chosen for 0.3 because it is an extension. If 0.3 is at $35, the 161.8 extension level will be 51.18. It is $35 plus 16.18. The 100 and the 200% levels are not official Fibonacci levels, but they are useful since they project a similar move to what just happened on the price chart. So what do Fibonacci numbers and lines tell you? Some traders believe that Fibonacci numbers play an important role in finance. As we've discussed, a Fibonacci number sequence can be used to create ratios of percentages that traders use. These include 23.6, 38.2, 50, 61.8, 78.6, 100, and then 161.8, 261.8, 423.6. You will just learn by default these numbers once you start trading daily. The percentages are applied using many different techniques. So in this lesson, we will learn about Fibonacci retracements, Fibonacci extensions, Fibonacci arcs, Fibonacci fans, and Fibonacci time zones. Fibonacci retracements are horizontal lines or on the chart that indicate areas of support and resistance. Fibonacci extensions are again horizontal lines on a chart that indicate where a strong price wave may reach. Fibonacci arcs are compass-like movements stemming from a high to a low that represent areas of support and resistance. Fibonacci fans are diagonal lines created using a high and a low that represent areas of support and resistance. Fibonacci time zones are vertical lines into the future designed to predict when major price movements may occur. So we will have a look at each one of these tools in a moment. Fibonacci retracements are the most common form of technical analysis based on the Fibonacci sequence. During a trend, Fibonacci retracement can be used to determine how deep a pullback could be. Impulse waves are the larger waves in the trending direction, while pullbacks are the smaller waves in between, or corrections. Since they are smaller waves, they will be a percentage of a larger wave. Traders will watch the Fibonacci ratios between 23.6, 78.6, and during these times, if the price stalls near one of the Fibonacci levels and then starts to move back in the trending direction, a trader may trade in the trending direction, either buy or sell. Fibonacci levels are used as guides, possible areas where a trade could develop. The price should confirm prior to acting on the Fibonacci level. In advance, traders don't know which level will be significant, so they need to wait and see which level the price respects before taking a trade. Arcs, fans, extensions, and time zones are similar concepts, but they are applied to charts in different ways. So each one shows potential areas of support and resistance based on Fibonacci numbers applied to prior price moves. These support or resistance levels can be used to forecast where price may stop falling or rising in the future. So are there any limitations using Fibonacci numbers and levels? The usage of Fibonacci studies is very subjective since the trader must use highs and lows of their choice. And every trader has a different choice based on his own strategy. Which highs and lows are chosen will affect the result of which the trader will get from Fibonacci. Another argument against Fibonacci numbers is that there are so many of the levels that the market is bound to bounce or change direction near one of them, which is making the indicator look significant in hindsight. The problem is that it's difficult to know which number or level will be important in real time or in the future. So next, let's look at the Fibonacci retracements. For unknown reasons, the Fibonacci ratio seems to play a role in the stock market, Forex market, financial markets like whole, just as they do in nature. And this is proven. Technical traders tend to use them to find critical points where an asset's price momentum is likely to reverse. Fibonacci retracements are the most widely used tool from all the Fibonacci trading tools. That is partly because of their relative simplicity and partly due to their applicability to almost any trading instrument, or basically to every trading instrument. They can be used to draw support lines, identify resistance levels, place stop-loss orders, and set target prices. Fibonacci ratios can even act as a primary mechanism in a counter-trend trading strategy. Fibonacci retracement levels are horizontal lines that indicate the possible locations of support and resistance levels. Each level is associated with one of the above ratios or percentages. Each shows how much of a prior move the price has retraced. The direction of the previous trend is likely to continue. However, the price of the asset usually retraces to one of the ratios listed above before that happens. The following chart here as example illustrates how Fibonacci retracement appears. Most modern trading platforms contain a tool that automatically draws in the horizontal lines. Notice how the price changes direction as it approaches the support and resistance lines around Fibonacci levels. The 50% retracement level is not a Fibonacci ratio, but traders often use it because of the tendency of asset prices to continue in particular direction after or before 50% retracement. Do Fibonacci retracements have pros and cons? Despite the popularity of Fibonacci retracement, the tools have some conceptual and technical disadvantages that traders should be aware when using them. The use of Fibonacci retracement is subjective. Traders may use a technical indicator in different ways. Those traders who make profits using Fibonacci retracement verify its effectiveness. At the same time, those who lose money say it is unreliable. Others argue that technical analysis is a case of self-fulfilling prophecy. If traders are all watching and using the same Fibonacci ratios or other technical indicators, the price action will not be so colorful. The underlying principle of any Fibonacci tool is a numerical anomaly that is not grounded in any logical proof. So the ratios, sequences, and formulas derived from the Fibonacci sequence are only a product of a mathematical process. This does not make Fibonacci trading unreliable. However, it may be uncomfortable for traders who want to understand the rationality behind the strategy using Fibonacci. Furthermore, a Fibonacci retracement strategy can only point to possible corrections, reversals, and counter-trend bounces. This system struggles to confirm any other indicators and doesn't provide easily identifiable strong or weak signals. So next, Fibonacci extensions. What are Fibonacci extensions? They are a tool that traders can use to establish profit targets or estimate how far a price may travel after a pullback is finished. Extensions levels are also possible areas where the price may reverse. This tool also uses the Fibonacci sequence ratios. So a quick recap of how the sequence looks. The ratio between any numbers in the sequence and the previous number is 1.618. Very important. The formula for Fibonacci extensions. Basically, there is no formula. Fibonacci extensions don't have a formula. When the indicator is applied to the chart, the trader chooses 3 points. The first is the start of a move, the second point is the end of the move, and the third point is the end of the retracement against the move. So the extensions help project where the price could go next as a price target. Once the 3 points are chosen, the lines are drawn as percentages of the move. It's automatically done by any trading charting tool out there. MetaTrader, TradingView, they all have these tools. So how to calculate Fibonacci extension levels? You don't have to know the formulas, but it is good if you just logically think what is Fibonacci and what is behind the calculations. So why the price is acting like this. These are not some magical levels. There is a mathematical formulas behind, or not formulas, but mathematical explanation. But you don't have to remember how to calculate, just to have the vision, what is going on. So Fibonacci extension levels, you need to multiply the difference between points 1 and 2 by any of the ratios desired, such as 1.618 or 0.618, and this will give you amount in dollars. So if projecting a price move higher, add the dollar amount above to the price at point 3. If projecting a price move lower, subtract the dollar amount from step 1 from the price at the point 3. I will explain now. For example, if the price moves from $10 to $20, back to $15, $10 will be 0.1, $20 will be 0.2, and $15 will be 0.3. The Fibonacci levels will then be projected out above $15, providing levels to the upside of where the price could go next. If instead the price drops, the indicator would need to be redrawn to accommodate the lower price at point there. So if the price rises from $10 to $20, and these two price levels are points 1 and 2 used on the indicator, then the 61.8% level will be $6.18 above the price chosen for point 3. It's 0.618 multiplied by the difference between 10 and 20, which is $10. So $10 multiplied by 0.618 will give you $6.18 above the price chosen for point 3. In this case, point 3 will be $15. So the 61.8% extension level will be $21.18. You add $15 to 6.18, or the reverse. You add 6.18 to $15, which is 0.3. So the 100% level is $10 above 0.3 for an extension level of $25. It will be 1 because it's 100%. So you take 1 multiplied by the difference of $10 plus $15, and this will be the the 100% level. The ratios themselves are based on something called the golden ratio. To learn about this ratio, we need to start a sequence of numbers with 0 and 1, and then add the prior two numbers to end up with a number string similar to this: 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, etc. The Fibonacci extension levels are derived from the number string, excluding the first few numbers. As the sequence gets going, if you divide one number by the prior number, you get a ratio approaching 1.618. The 100 and 200% levels are not official Fibonacci numbers. They are useful since they project a similar move to what just happened on the price chart. So what do Fibonacci extensions tell you? Fibonacci extensions are a way to establish price targets or find projected areas of support or resistance when the price is moving into an area where other methods of finding support and resistance are not applicable. If the price moves through one extension level, it may continue moving toward the next. With this said, Fibonacci extensions are areas of possible interest. The price may not stop or reverse right at the level, but the area around it may be important. So for example, the price may move just past the 1.618 level or pull up just shy of it before changing directions. So the area is important. Fibonacci levels can be calculated to give the trader ideas on profit target placement. The trader has the option to decide whether to cover the position at that level or to cover partly the position. What's the difference between Fibonacci extensions and Fibonacci retracements? So the extensions show where the price will go following a retracement. Fibonacci retracement levels indicate how deep a retracement could be. In other words, Fibonacci retracements measure the pullbacks within a trend, while Fibonacci extensions measure the impulse waves in the direction of the trend. Are there any limitations of using Fibonacci extensions? Fibonacci extensions are not made to be sole determinant or whatever to buy or sell. Traders should use extensions along with other indicators or patterns when looking to determine one or multiple price targets. Candlestick patterns and price actions are especially informative, together with Fibonacci tools. There is no assurance price will reach or reverse at a given extension level. If it does, it's not evident before a trade is taken which Fibonacci extension level will be important. The price could move through many of the levels with ease or not reach any of them. Fibonacci fans and arcs. Let's see. So Fibonacci ratios are used in different ways. Fibonacci fans and arcs are tools to find potential support and resistance levels. Just like other Fibonacci tools, fans are drawn from the swing low to the swing high. The tracing trend lines of 38.2, 50, and 61.8% can be seen in the chart. The trend lines can then be used to find the support and resistance areas. As you can see on this chart, the price has bounced several times from the fan lines as the price breaks the 61.8 line. It is signaling the trend consolidation. It doesn't necessarily mean that the trend is reversing. It can also be that the trend is paused and maybe stuck in a range, and therefore you should use range trading strategies or tools. Fibonacci arcs work exactly the same way. They are drawn from the swing high to the swing low and show the potential support and resistance areas. Here you can see the price is trading down along the 38.2% arc line until it breaks the previous lows and then continues to take the lower leg. Channels, next. What is Fibonacci channels? The Fibonacci channel is a technical analysis tool that is used to estimate support and resistance levels based on the Fibonacci numbers. It is a variation of the Fibonacci retracement tool except with the channel, the lines run diagonally rather than horizontally. In order to draw a Fibonacci channel, the trader must first determine the trend direction. The Fibonacci channel can be applied to both short-term or long-term trends, as well as to uptrends and downtrends. It doesn't matter. The lines are drawn at 23.6, 38.2, 50, 61.8, 78.6, and 100%. The extension levels might be 161.8, 200, 261.8, 361.8, and 423.6%. At the discretion of a trader, it doesn't mean that you need to use every single one of these levels. It's all on your choice. A Fibonacci channel doesn't require a formula as well. The channels are drawn at certain percentages of the price moves selected by the trader. In an uptrend, selecting a starting point, a low, and then another higher swing low. This creates the zero line, since this is where the channels start. This line creates the angle of the channel. All other lines are drawn parallel to this line. Also, select the swing high in between the two lows. So you also will have 3 points: swing low, higher swing low, and then swing high in between the two lows. The distance between the low point and the high point is 100%. The 100% line will extend out to the right at the same angle as drawn zero line. The distance between the starting point and the high is used to create the additional levels. The same concepts apply to a downtrend. You need to select a starting point, which in downtrend will be high, and then another lower swing high. This will create the zero line. Then you need to select a swing low in between the two highs. The distance between the high point and the low point will be 100%. The 100% line will extend out to the right at the same angle as the drawn zero line. Parallel. The distance between the starting point and the low is used to create the additional percentage levels. So next, how we use this Fibonacci channel tool. The tool is used to aid in identifying where support and resistance may develop in the future, similar to other Fibonacci tools. If the uptrend is expected to continue, the 100%, 161.8%, and the other higher levels are potential price targets. The same concept applies to downtrends if a downtrend is expected to continue. In an uptrend, the zero line is like a normal trend line, helping to assess the overall trend direction. If the price falls below it, it may need to be adjusted based on more recent price action, or it could signal that the uptrend is over and that the price is breaking lower. In a downtrend, the zero line also acts like a trend line. When the price is below, it helps confirm the downtrend. If the price moves above it, the indicator may need to be redrawn, or the price is moving higher out of its downtrend, or it's changing trend direction. Okay, next, Fib clusters. What are Fibonacci clusters? A Fibonacci cluster is where a collection of Fibonacci retracements or extension levels based on various price swings convene near one price area. The theory of a cluster is that if multiple Fibonacci extension or retracement levels are near one price, the same price, that price is likely to be an important support or resistance area. A trader then potentially take a trade near that level. A trader may draw retracement and extension level on various price swings For example, they may draw a large one on a weekly chart, then draw some on the smaller daily and hourly price swings. With multiple Fibonacci tools all over the chart, some will cluster together near a certain price point. This Fibonacci cluster marks a potentially important area as a Fibonacci level from more than one price swing is saying that this area is likely to be support or resistance. So it is a strong zone. You always need to combine Fibonacci with other technical analysis tools in order to create your correct analysis. Since drawing Fibonacci retracement is very subjective, it's useful to combine it with other technical analysis tools. For example, with price action, with different indicators, oscillators, trend lines and channels. Now we will have a look. Combining pips with polarity change. This is a great way to use Fibonacci retracement, looking for the Fib levels, which interacts with all support and resistance lines, like here, price broke the previous highs and started pulling back. The older resistance should become the new support. So you may be going long on the retest of this level. Many traders have problems choosing their stop loss levels, and Fibs are especially useful in situations like this, as you can simply put your stop loss a couple of pips below the 61.8% retracement. You can combine Fibs with trend lines and channels as well. For example, if the price is in a strong uptrend, after making the next leg higher, you need to wait for a retracement before going long. By drawing Fib retracement, you can project the potential point where the price will hit the trend line and set your buy orders there. You can combine Fibs with indicators or oscillators like RSI, MACD, stochastic. Combining with Fib retracements, it's working very well. For example, if the price is styling at around 38.2% Fib retracement, normally it will be risky to sell based only on Fib retracement, as it could go further. However, if the RSI has already broken the bullish momentum, it may signal that the retracement up has finished and the price is ready to resume its downtrend. So next, let's have a look at the most common mistakes that traders do using Fibonacci. Every Forex trader will use Fibonacci retracement at some point in their trading career. Some will use it just some of the time, while others will apply it regularly. But no matter how often you use this tool, what's most important for you is to use it correctly every time. So don't mix reference points. This is one of the biggest mistakes. Incorrect analysis and mistakes are created once the reference points are mixed. For example, going from candle wick to the candle body. This is reference mixing points. So if you start drawing a trend line, just draw it from wick to wick or from body candle to body candle. Don't mix wick to body. Just don't. By keeping constant analysis, correctly analysis, support and resistance levels will become more apparent to the naked eye, speeding up analysis and leading to quicker decisions and quicker trades. Okay, so second, don't ignore long-term trends. Beginner traders, new traders often try to measure significant moves and pullbacks in short term, without keeping the bigger picture in mind. This narrow perspective makes short-term trades more than a bit misguided. By keeping tabs on the long-term trend, a trader can apply Fibonacci retracements in the correct direction of the momentum and set themselves up for great opportunities. So don't ignore long-term trends. You need to have an eye on the bigger picture. Don't rely on Fibonacci alone. As I said before, Fibonacci can provide reliable trade setups, but not without confirmation from other technical analysis tools like price action, support and resistance, trend lines, trend channels, etc. Indicators. Applying additional technical tools will support the trade opportunity, and this may increase the likelihood of a great trade. Without these methods to act as a confirmation, a trader has little more than hope for a positive outcome. Use Fibonacci for short-term. Day trading in the Forex market is exciting, but there is a lot of volatility, especially for a new trader. You will see a lot of noise and you won't be able to recognize the main moves in the chart. For this reason, applying Fibonacci retracement over a short time frame is ineffective. The shorter the time frame, the less reliable the retracement levels. Volatility can and will skew support and resistance levels, making it very difficult for a trader to really pick and choose what levels can be traded. Not to mention, in the short term, that spikes and whipsaws, fakeouts, fake breakouts, they are very common, and these dynamics can make it especially difficult to place stops or take profits point for a beginner trader. Okay, so let's summarize today's lesson. What are the key takeaways from today's lesson? So, Fibonacci numbers and lines are created by ratios found in Fibonacci sequence. Common Fibonacci numbers in financial markets are 0.236, 0.382, 0.618, 1.618, 2.618, 4.236. These ratios or percentages can be found by dividing certain numbers in the sequence by other numbers. While not officially Fibonacci numbers, many traders also use 50% and 100% and 200%. The numbers reflect how far the price could go following another price move. For example, if a price move from 1 to 2, Fibonacci numbers can be applied. A drop to 1.76 is a 23.6% retracement of the $1 price move around. Two common Fibonacci tools are retracements and extensions. Fibonacci retracements measure how far a pullback could go, a correction, and Fibonacci extensions measure how far an impulse wave could go.